All right, guys, another great episode of PFREI. I'm your host, Fuquan Bilal, a passion for real estate investments. Today we have Tim Lyons, City Side Capital. This is going to be an interesting one. The last podcast, this is in the same vein from the last guest I had. We were talking about raising capital, and that was the first on the show. I've been doing this podcast now for over 2 years, and that was the first time I had one specific speaking about their model on raising capital. It was actually a fund manager who do some unique stuff. But today, I have Cityside Capital, Tim Lyons. We're going to get into a couple of things. As I was speaking with Tim, they strategy is a bit diverse. Which is most intriguing to me is the broker dealer stuff that you guys are doing. So, without further ado, welcome to the show, man. I really appreciate you taking time. I know you're busy. Thanks for coming to the show to add value to our listeners. Appreciate it.
Yeah. Well, listen, thank you for having me as a guest. It's a pleasure to be here.
Awesome. So, give your background. Who you are, what you do. How did you get your start in real estate? We'll start off with that.
All
And
the
then
good stuff. So listen, so I'm a New York City firefighter, right? I work as a lieutenant in the borough of Queens, been doing that a little over 18 years. And for about 10 years, I was a ER nurse in a level 1 trauma center. During that time, so being a nurse was my side hustle, right? Because I'm no stranger to hard work. I just, that's what I did. 2 vacations a year, bills were paid, retirement accounts, were being funded. But in the process, I had 3 little girls with my wife. And now they're 12, 9, and 4. So when they're little, they don't ask a lot of questions, right? But then when they get bigger, they start to miss you and you start to miss them. And I realized that trading time for money, although I didn't mind doing the work, was not conducive to my, what I wanted to have my lifestyle be like. So I did a lot of self-education, self-reflection, the podcast, the books, and the seminars and everything. And what I really came down to was 2 things, either owning a business or real estate. And the reason was because of equity and cash flow. I already had 2 jobs, so I didn't want a third, really. So I didn't want to start a business. So I went to real estate. So I was super, super scared to do it, I guess. A lot of limiting beliefs. I'm from New York City, right? So just, trust but verify. Everyone's guilty till proven innocent in my mind, right? So I wanted to be able to be a landlord and feel the property, touch it, do the things, get the experience, and so I did a 3-family with a friend of mine, right? I wanted to de-risk as much as possible. But it was an hour and a half away from my house, and it got old quickly. Mowing the lawn, whose turn is it to shovel the snow? Oh my God, the hot water heater doesn't work. There's a bat in the back stairwell. My windows are shaking. I mean, I hated being the landlord because I cringe every time the phone rang. So during that period of time, I was now a firefighter, a dad, a husband, a ER nurse, and my wife's like, I thought this real estate was going to be passive income, and it seems like you have another job. And I was like, that's the same way I feel. So I continued on the education piece, and that's when I really, got into commercial real estate. Found myself a mentor. My mentor gave me an incredible amount of knowledge and confidence to go out there, and gave me the opportunity to join him on a deal. And that was, the law of the first deal kicked in. And before you know it, I was off to the races.
that's awesome, man. It sounds fun and exciting, wearing all those different hats all over the place. And now you seem like you have your mission and your assignment, and you understand that going deep is better than wide, and staying laser focused. So the first question I have for you, and I ask all the guests on the show, why are you passionate for real estate investing?
I'm passionate about real estate investing because once I got financially educated, meaning realizing how money works, realize how money in banking and the relationship it has works, realizing that debt is not to be considered a 4-letter word like the other 4-letter words that we're not supposed to use. That it was there to serve us. And once I unlocked that, math equation, I realized that I could put my money to work and could really derive passive income and equity upside. And if I could just find a way to velocitize that money, it was going to open up doors for me and for my lifestyle and for my trajectory that otherwise wouldn't have been available to me. So I think the whole picture, the whole package was it was the education and the action that real estate has brought to my life, and it's like a almost like a love interest at this point. I'm obsessed with real estate.
That's awesome. Heart is on fire. That's amazing.
That's it.
It's been a 24-year journey for me, and I feel the same way. I'm not burnt out yet. I think this is the only business, Tim, that I actually noticed that you never learn everything, right? There's always something, there's so many different facets of it. It's incredible, right? And it just gets me excited when I learn something new, a new strategy, whether it's tax liens, multifamily notes, whatever it is, right? When you learn something new, the way you can structure a deal and become a deal architect, so to speak, it just makes it, more exciting. You never get bored. So let's talk about your model a little bit because we were talking a little bit before, we started recording, and we're talking about the broker dealer services that you guys provide or the raising capital services. Let's jump into that and explain to listeners how that works.
So there's a whole realm of real estate investing, and just to stack on top of what you said, there's a million ways to make money in real estate, right? I think we all know that by now. But which way is your way? And that's what everybody has to kind of figure out for themselves. But there's a huge, huge area of real estate investing that is passive in nature, right? So you might hear it referred to as syndication or group investing or something like that. But so what we do is if there's an investor out there that has capital sitting in a checking account or a savings account, and they're a high earner or they're an accredited investor and they just know that they should be in real estate but they don't know how to get started and they don't necessarily want to be a landlord, that's kind of where we fit in, right? So we are capital raisers for established operators across the US. We have 10 operators that we work with, 8 multifamily, 1 self-storage, and 1 industrial triple net lease. So, there's a diversification of asset classes as well as diversification of, markets across the US. So we connect them, the investor, with vetted operators and vetted deal opportunities. So because we're licensed with our FINRA securities licenses and we are affiliated with a broker dealer, we have to raise capital under what's called the suitability clause, right? So we have to make sure that the investor is suitable for the, private placement, direct participation programs. So being a passive investor in a multifamily syndication or a self-storage syndication. But we also have to do due diligence on the issuer or the sponsor of the project, right? So that's why we take great pains to do upfront due diligence. It's usually a several week process. It's rather expensive, for the issuer to undergo this and process. But we have to kind of bridge that gap between, due diligence on the issuer, due diligence on our investors, so that there's a synergy, for both of those folks to mutually benefit. So what do we do? So we, in the due diligence process, we onboard these issuers and we go through their track record, and we have a third party due diligence firm that makes sure that the LLCs are set up correctly and they're, in good standing and they own the properties they said they owned and they sold the properties they said they sold, and that there's no criminal history, with criminal background checks. And because, if you're a passive investor, there's a reason why you want to be passive, right? You don't want to be active. So, how do you know what the right questions are to ask about an operator, right? How do you know if a market is where you want to be or a deal is, for you or something like that? So, and while we don't make recommendations, we're not financial advisors, we do connect, vetted operators with capital.
That's awesome. So what does that look like? Someone's raising capital for, let's say, a multifamily deal. They already have a approval from a lender with permanent financing, 75% or 70% in this market, maybe 6.5% or whatever it is, 6%. And they're looking for some type of gap funding, right? So they got to put together the closing costs, another 3.5 million, maybe some capex expenses, whatever. So what does that look like? Someone comes to you with that type of deal and go, hey, it's a $10 million deal. I need to raise another $3.5 million. Can you help me? What is, you go through the vetting process of the sponsor. to see if they would fit your criteria to possibly become a strategic partner in your operation. And then I'm presuming on the back end you already have relationships with accredited investors who's looking for an opportunity that you guys have vetted. What does that deal look like for the sponsor who pass all the checks that you have? And how do you guys fit into play? Is there a GP part of the deal you get to go in that GP portion to kind of have some control over the asset? What does that look like?
Great questions. So, just to be clear, like we don't talk with groups that or work with groups that have a deal. Like the relationship has to go back, probably several weeks or months, with an introduction, and they say, all right, you guys are experienced and you guys are, say, vertically integrated, and you're in a market that that we're not in yet, or we want to have more exposure to. This is what we can offer you. Are you interested in going through the process? Yes, cool. Let's get the ball rolling. A couple of weeks later, everything checks out. Now they're onboarded onto our platform. Now, if they have an opportunity and they go into contract, they send us, three things: the underwriting, the trailing 12 months of profit and loss statements, and the most current rent roll. And we have our own underwriter on our platform that will go through their underwriting, make sure that the assumptions are, within, industry standards. They go through the reports, they go through the rent roll, they go through the P&Ls, so then we get a report, registered reps, saying, here's what the underwriter found, and here's the CoStar report and the Yardi report, and here's everything that you need to do to make your decision. So then my partner, who's my brother, and I will figure out if we want to work the deal or not, and how much allocation that we want to take. Do we want $1 million or $5 million or whatever it is, so that we can raise capital for this deal. So let me back up, though. So we have this pre-existing relationship with the issuer or the sponsor. They're already vetted. They're already on the platform. Now they're able to raise capital. But I get a phone call probably once a day or an email several times a day saying, hey, I heard you raise capital. I got a smoking hot deal. I need another $3 million. And unfortunately, that's not how that can work. So it's really so people ask all the time, well, how do we get paid, right? Like, why, it seems like we're a middleman, right? So basically we're a connector of capital. So the issuers that we work with, or the operators that we work with, they can all raise millions of dollars by themselves, but the deals are expensive, right? We're doing 10, 20, 30, 40, up to 70. I think our most expensive deal is $74 million. So there's a lot of equity that has to be raised for these types of deals. So yes, they can raise the money by themselves. Yes, they've been experienced in doing that, but we're also another cost of capital. So we have agreed upon, how much our capital costs to bring it into the deal. And then our broker dealer is a general partner in that deal. So we get carry on the back end equity, and we get something, up front. We call it a commission. Other people call it a syndication fee. So that's kind of how the business model works, right? It's the operator's cost of capital for the equity for the deal. So people ask me all the time, well, if I have, say, $100,000 that I want to bring into one of these deals, is my capital account going to reflect all $100,000, or are there fees that come out? And the answer is, if you're a limited partner, aka a passive investor, no, your capital account will have $100,000. It's the issuer's cost of capital that they got to pay us.
Yeah, they pay sort of like a commission, like you said, for you guys assisting them to put the equity together to get the deal done. And then on the management company side, you said the broker dealer partner has GP somewhere in the GP of that deal, split, and is a split with the other managers that's running
the lead manager, or the issue. We call it an issuer. It's just financial parlance, but it's really the operator, right? Or the
team that's going to ask the management. Got it. Interesting. Yeah, I mean it's so it's just storage, multifamily. Let's talk about some of the asset classes that you guys play that role in funding.
So the majority of the portfolio is multifamily, right? My brother and I, that's kind of where we started, was small residential. Then we got into a 43 unit, then 144, and then 148 units. 144 was in Greenville, South Carolina, and the 148 is in Sarasota, Florida. So we did those three deals as general partners ourselves, and then we realized that commercial multifamily and commercial real estate in general is a team sport. Real estate is a team sport. And we had to find our spot on the team. And, I wasn't moving to one of these locations like Phoenix, Arizona, or Austin, Texas, anytime soon. My wife was not moving, so that was out. But what we were good at was, investor relations and raising capital and, getting on the finance side of the deal. So we decided to, get our FINRA licenses, our Series 82 and Series 63, and we joined forces with this broker dealer. And people, just real quick, people get confused about broker dealer, and they're like, "Is that like a real estate broker? Like, how does that work?"
Yeah.
And the answer is this: like, J.P. Morgan, Goldman Sachs, Vanguard, those are largely broker dealers, right? They buy and sell securities for the benefit of themselves and their investors, right? Um, we are broker dealers that only focus on, commercial real estate investments for passive investors. We don't do stocks, bonds, ETFs, life insurance, annuities, nothing like that. It's only multifamily, self-storage, and industrial triple net leases. So the multifamily side, our investing thesis is just that people need food, clothing, and a place to live. Right? Turns out people like to go to bed with a roof over their head at night, and that's part of our investing thesis, and it's worked out well for us. The second thing is self-storage. Self-storage in the last, say, 6 months has been a little bit soft, right? There's been a lot of construction, a lot of new units coming on board, and but self-storage is another compelling asset class to us because it's a low-cost way to store our stuff, and we're a consumption society. We don't like to get rid of, mom's, bureau or dresser when she passes away or anything like that, or we don't like to get rid of, little Johnny's third grade drawings, so we put it in self-storage. And for us as operators, a lot of self storage is on, a payment by card, right? So every first of the month, everyone's card gets hit. It's not waiting for people to pay cash or, bring in a check largely. And if they don't pay, there's a notice to quit, and they get evicted, right? And what do? We cut the lock. We get somebody, that's paid an hourly wage to clean out the locker, and we broom sweep it, and we rent it, right? So it's a very, scalable model, I should say. So those are the sheds and the beds that we call it. Then the third thing is industrial triple net lease. And for people who don't know what a triple net lease is the tenant is responsible for the taxes, insurance, and the maintenance of the property. So it's usually at least a 5-year up to, I'd say, a 20-year lease for a company, right? That has, whether it's boxing, manufacturing, metalworking, who knows, some sort of manufacturing kind of business that has a good credit profile, right? Strong balance sheet, and they want to, have this lease, this long-term lease with agreed upon, rent bumps, and it's triple net. So it's a cash flow play, and it's rapidly becoming one of my favorite asset classes. So I'll throw it back
no,
to you.
no expenses.
No
You pass
expenses.
all expenses on to the tenant, and you just get the cash flow, right?
That's right.
Yeah, that's awesome. Yeah, man, that's some great stuff. I like that as well, diverse. It seems like the investor capital, I'm assuming, is going into some sort of so my other question is, does that capital go directly into that syndication, or does it goes directly into that syndication? Okay, because all right, so it's
So
all
yeah, we do single asset deals, right? The majority of our stuff is single asset opportunities. So 280 units in Dallas Fort Worth, or 142 units in, I don't know, Florida somewhere. But we also do funds, right? We have multifamily funds with different operators that we work with. We have a self-storage fund, and we do have a fund for that industrial triple net lease. So funds are, obviously multiple properties under one fund. So there's two different ways to get involved.
So what is it as far as returns, right? So we're in a marketplace where interest rates are increasing, and it's harder for investors to really hit those returns that's on a pro forma, right? I see some guys in multifamily promising 22%. We're gonna make all this and that. And I'm just like scratching my head, like, wow. It's one thing if the property is underperforming, and the property management company is not doing a job, and you can implement rubs, and you can do a lot of stuff to increase cash flow, and rents are 30% below market, and you can do some things to make it happen with low capex in a short period of time. But a lot of people are still over promising and under delivering, even in this marketplace where it's really tough. What are you seeing in your end in reference to the current marketplace? What challenges are you guys facing? Either your strategic partners, what challenges are they facing?
So, returns are a funny thing, right? Because in the real estate syndication world or the passive investing world, it's all pro forma, and pro forma literally means like your best guess, right? So anybody who thinks that they can look at a pro forma and they're going to get exactly what it is on that the spreadsheet happens to say, no, like it's ballpark. It's like, that's what we're thinking we can do. But yes, I would say right now, the challenges in the commercial real estate space or real estate in general is that interest rates have shot up, right? The Fed went from saying, we're not even thinking about raising interest rates to going on like a 13-month tear, going up like 550 basis points. So what does that do? That means that people who had variable rate debt, or sometimes referred to in commercial real estate as bridge debt, if they didn't have a rate cap, which means a ceiling put on to that payment, they got caught, right? And they started bleeding cash really quickly, and that leads to a couple of things. One of them could be a capital call, where they go to investors and they ask for more money to keep the deal alive. Number two, they can sell and hope to eke out a gain or perhaps a small minimized loss. Or the worst situation is, a foreclosure, right? So right now there's a wide bid-ask spread. The sellers want, yesteryear's prices, and the buyers want a extreme discount. So when you read something in the Wall Street Journal that says that it's not a lot of properties trading, that's kind of why. But the properties that are trading are, either properties that were bought 5, 7 years ago. They've implemented their business plan, and they're just ready to sell. They've already made their profits, right? But there's largely, other problems of people who need to sell because of those debt problems. They're running out of time and they're running out of money. So that's where, companies like us can pick up these good deals, right? I mean, what's funny to me is that there was a tremendous amount of inflows to commercial real estate, residential real estate over the last, since COVID, right? You saw the prices were going through the roof, and everybody wants to get in at that time. Where, my argument right now is, nobody wants to get in, but, if you talk to anybody who came out of 2008 and 9 and you ask them today, what do you wish you would have done differently in your career? They would have said, man, I wish I would have bought more in 2009, 10, 11, because those were the years, right? So it's hard to see sometimes, right? And I don't claim to know how to have all the answers, but nobody wants to catch a falling knife. But at the same time, when there's uncertainty and fear out there, it becomes harder to make these deals happen. So right now, we're basically positioning ourselves for the people who need to get out. We're finding deals at, say, anywhere from 15 to 25% discounts from prices just, 12, 18 months ago. And, when you get at a good basis, just to answer your question, I guess, when you get a deal at a good basis and you have attractive debt terms and you have a timeline with a business plan, and you can execute that business plan in that time frame, there's successful deals out there, right? And that's kind of what we're seeing. So we're seeing that the cash flow is probably lower than people are expecting, from even just like a year or 2, 3 years ago, maybe. But that's because the interest rates have shot up, and something has to give, right? The capital stack has to adjust to this higher rate environment. Is it going to last forever? No, right? So you talk to people who have been in this game for decades, and they say, when I got a deal at 9%, I thought I was killing it, because that's just what it was, right? But so I think the markets will adjust. I think deals will start happening more and more as people have more and more distress. Operators like who I work with, nobody wants to do a capital call, and nobody wants to. Baby. No, you have to. You have to go back up. Thank you.
Nobody wants to do a capital call for investors if they fall short because of those adjustable rates, you're saying.
Exactly. Right. I mean, people who do capital calls, I mean, it's hard to run your business, for at least a little while after that, if you can ever recover. Right. So, that's why it's important, right? I mean, when you have if you're a passive investor, you have to have a checklist, right? You have to have due diligence, vetting sponsors, vetting that track record. You want to know the deal is well capitalized, right? So as a quick story, I heard somebody the other last week was telling me, I'm still getting marketed this deal that closed almost 60 days ago in Texas. And I said, well, why are they still raising capital? And he's like, well, they still need more capital. And I said, well, listen, I wouldn't do that deal personally because that means that they're undercapitalized. They had enough money to close the deal, to get the deal across the finish line. But what if something goes wrong, right? It doesn't sound like they have reserves if they're still trying to raise capital. That means they're raising capital for their reserves and they're raising capital for their CapEx and deferred maintenance budgets. That is terrible to me, right? Right now, there's a lot of headwinds. We're talking interest rates. We're talking insurance costs. Insurance costs across the entire country have gone bananas, right? So whereas in multifamily, you may have done underwriting, say at $200 or $300 per unit per year, and that was maybe going to be your ballpark insurance cost. Well, now you can double or triple it if you're lucky, right? So interest rates, insurance costs, labor. Labor is a huge problem in a lot of the markets, right? They can't find HVAC technicians. They can't find full-time managers or, leasing agents, so labor is a problem. Supply chains, construction materials for renovations. And I can go on and on, but that's why you have to work with experienced folks who are well capitalized. They didn't just go to a seminar last weekend and learn about real estate syndication. And now they're going to take people's money, right?
Yeah.
So that's what that's pretty much the service that we offer our investors is, look, this is what we love to talk about. This is what I love to do. I love to look at pitch decks and underwriting and research reports and stay up to date on what's going on in the markets, because at the end of the day, I'm investing in these deals as well, right? I mean, I got my own. You just saw my little 4-year-olds come into the picture. I got 3 of them, so that's who we seek to serve: passive investors who want solid deals.
That's awesome, man. I really appreciate you coming to the show today and adding value. Tim Lyons, City Side Capital, ladies and gentlemen. And you said from Queens. Queens get the money.
That's right. That's right. I was a fireman for 10 years in Crown Heights, Brooklyn, and then now I work in Corona, Queens.
Okay. All right. So give the guests a place where they can reach you, website, social media, and all that good stuff if people are interested in learning more about what you guys have to offer.
Yeah, so you can always head over to citysidecap.com. You can schedule a call with us. You can check out some of our past projects. We got some good information on the website. We have a podcast called the Passive Income Brothers Podcast. Me and my older brother, Greg, batted around with a couple of real estate veterans. So that's another place. And then my email is tim@citysidecap.com.
Awesome. Thanks for coming to the show, man. Another great episode of PFREI, a passion for real estate investments. I'm your host, Fuquan Bilal. Be sure to check us on YouTube, Facebook. Be sure to like and share this, and you can catch us anywhere where you can find a podcast, I guess. All right, guys, that's it. It's a great show today. Appreciate you coming on, man.
Thank you for having me.